Hello and welcome to Chapter 13, Financing for Startups from the Entrepreneurship 3rd edition textbook. So we're looking at a couple of ways to finance your company in terms of getting your thing started. There's several ways. There's equity, bootstrapping, using your own personal money, loans, and so equity financing is basically the sale of your shares for cash. So a company shares a share of their stocks in exchange for cash. It's a way to get capital from investors to start grow a business. I will say that you don't want to give too much capital away from your company because you want to still remain keeping control of your company. This, of course, doesn't work for every style of company. So if you own a lawn service company and you're only cutting a couple of houses, the grass from a couple of houses, this may not work. You don't really show a lot of potential in growth as much compared to if you were starting the next Google or the next Facebook, which is completely different. Of course, with equity financing, whether you're the only owner of the company, you own 100% of a small pie. Of course, when someone shares, they become part of that pie. So you're really sharing a piece of that pie. There's some stages of equity financing. The first one is the seed stage financing. It's basically small amounts of capital to prove the concept. Then there's the startup financing. Once the entrepreneur has been able to provide evidence that their concept is going to work, to continue to grow it. And then early stage financing is large amounts of funds to build a bigger team, but still has yet little revenue. And of course, some companies ask for more financing or second stage or late stage financing. That's when the company has hired employees, it's showing growth, but still needs more money to continue to grow. Probably a little bit of profit to no profit still, but making strides. And then, of course, there are companies who go public, initial public offering, and that's when they go on the stock market and people can invest and buy stocks. The stages of equity financing, the 3 F's: invest in cash in exchange for equity, provide a loan that can later be converted to equity or convertible note. There are angel investors, and angel investors is a single individual who uses their own money to provide funds to a young business, which are neither friends nor family. So there are angel investors out there who can probably provide you with 10, 20, 30, maybe 40, even $50,000 for your company. Of course, they're going to want a piece of the pie and they're going to want a say in the company. Venture capital is a professional investor who invests in emerging companies because of the long-term growth potential. Venture capital fund money is extremely very difficult to get. It's not easy. Usually venture capital firms are looking for the next high growth capital. So going back to my example of the lawn service business, they're probably more than likely not going to invest in a lawn service company compared to perhaps a company that's a digital tech company who shows high potential growth with many users, and they can see their investment grow within less than 5 years. They want a return on their investment within less than 5 years. Also know that venture capitalists invest probably in lots of companies, knowing that only one's going to make it big and the rest are going to fail. Also, you have to, because entrepreneurs seek equity investment, they must know the value of your company to see how much you're giving up. And fundraising is a full-time job, right? You're going to have to go out there and talk to many people to get that money. How can entrepreneurs value their companies? There are very few overnight successes. Just to note that for every Facebook, there's probably hundreds and not thousands of companies that have failed. Check with other similar companies in the industry, see how they're doing to determine the value. Of course, how do investors value startups? They look at the position of the company, right? How many people, the experience of the team's past successes. They really determine who is part of the company. How many people use your product or service? Do you have a distribution channel already set up? Whether the industry is popular with investors at the moment. Pre-money valuation basically means companies value before it receives outside investment, and of course, post-money is after it receives financing. So we are seeing companies the age of the unicorn. They're receiving a $1 billion valuation. Which is a rare thing, right? Less than 1% have a chance of even becoming a unicorn when it comes to startups. Think of your Ubers, Lyfts, Googles, right? Those are unicorns. Those style of companies, again, one for every 100,000 of businesses out there. It's very rare, but it's becoming sort of much more known thing for some pretty successful startups. Convertible debt is a short-term loan that can be turned into equity when future financing is issued. So it's basically a middle ground between debt and equity financing. Some benefits and advantages, right? Valuation becomes easier in the first round of financing. Of course, early lenders may not want to take the risk of having their money tied up until the debt is converted into equity. Angel investors, as I mentioned, they're typically wealthy investors. Again, it's just one individual. Angels are eligible to invest as long as they are accredited investors or who earn an income over $200,000 or have a net worth of $1 million, or they themselves have become successful entrepreneurs. But be careful as to who your angel investor is. Do your homework to see who it is. You can find angel investor in places like AngelList or Angel Capital Association. Some angels will accept only referrals. So be careful as to who you go out and get. So we have entrepreneur angels, corporate angels. So corporate angels are people, usually former business executives from big multinationals looking to use their savings or current income to invest. You have professional angels, doctors, lawyers, and dentists who like to use their savings and income to invest in entrepreneur ventures. And enthusiast angels. So these are wealthy, semi-retired entrepreneurs, executives looking to invest. When you're looking for an angel investor, don't always look for that entrepreneur angel. Look at those professional angels. You'd be surprised at how many doctors and lawyers and dentists and accountants who have a lot of money are actually willing to invest in your business. If you've ever heard of that restaurant, Texas Roadhouse, some of the first professional angels. It was a couple of doctors who actually the guy who founded Texas Roadhouse. He actually raised money from professional angels from some doctors actually. So think about that. The Texas Roadhouse, one of the most successful restaurants in the nation. He got his first initial funding from professional angels. So you never know who can invest in your company. Angel groups, right, pooling funds to invest together. Research suggests that women are better investors than men as they take more time researching potential ventures, spot more market opportunities, and take less on risk. Very few business angels from marginalized backgrounds. So again, do your homework as to who's going to be your angel. Venture capitals, mostly professional money managers, look for a return on their investment within 5 years or less. Again, they're not going to invest in something that they don't see that they're going to be able to cash out quickly. Of course, there's some ventures that do have seed funding. Even if VCs do invest in young companies, it becomes a price. They take more of an equity, more control. So do know that if, for example, you do have a venture capital firm in your company, they're going to want to say in it. They're going to want to have a stake, a significant stake in the company, and want to say in it because they're investing their money. So a little bit of history of venture capital dates roots to the 20th century, with wealthy families like the Rockefellers and the Whitneys were looking at ways to earn profits by investing in promising young companies. So basically started in the 1940s and 50s. And of course, the Small Business Investment Act of 1958 officially allows small business investment companies to finance entrepreneur ventures seeking startup capital. Of course, there has been some rocky history of venture capital. We had the dot-com bubble. Basically, when the dot-com bubble was during the dot-com bubble, anything that had a dot-com was just high valuation. And then Pets.com is one of the famous one, and other ones. Once there was a .com, and that thing bursted because it was high valuation and really no value for it. It just burst. It popped. So we had the .com crash of NASDAQ in 2000, where startups collapsed, leaving investors deal with huge losses. One of the very few people that actually made a ton of money was Mark Cuban. from it. And of course, we had the 2008 financial crisis during the housing boom, right? A lot of houses had high valuation and mortgages. And of course, we had the 2008 financial crisis. And so that really was, some predicted another dot-com boom with high interest rates and COVID-19 pandemic had deterred investments. So, is there going to be another a bubble, right? People are saying the AI bubble at the current moment, so we'll see what happens. How does venture capital work? It works within a specific investment portfolio. So venture capital firms define a type of their thesis, as it's called. Their thesis is basically a written word of what type of companies they want to invest in. So there are VC firms out there that only specifically focus on energy companies or ed tech companies, consumer companies, and then that's what they invest in, right? And so they take an interest in entrepreneurs who surround themselves with smart, talented, well-respected people. They want to see growth as well. Again, they want to look for a great team. They want to see big markets and a unique and innovative idea. And so most investors would rather have an A team with a B idea than a B team with an A idea, because without the right team, more likely will not be successful. Why some VCs may say no, or more likely say no, is because your company doesn't stand out from the crowd, and they don't see it as turning a quick money within 5 years or less. What about a bank loan? Can you get a bank loan? Yeah, you could, but it's not that easy, right? Usually banks lend to companies who are already established and who don't need the debt. Usually companies who have high debt, they're more than likely not going to get a bank loan because the bank does not want to take a risk because they know they're probably going to default on their loan. So, and when banks do loan out money, they're going to look at everything, perhaps everything, your business, how much money you're making, and perhaps do a credit check on you. Due diligence, a rigorous process carried out to evaluate the investment opportunity before being finalized. The due diligence for process for VCs do a lot of due diligence. They look at the company's financials. They spot any red flags. They see who the people are. They do a background check to see who they're dealing with. Exit and harvesting. VCs expect a return within 5 years or so, usually through a buyout, a selling of the company, or initial public offering. Acquisitions, right? Usually smaller companies are bought out by bigger companies. Usually that's what happens. When you start a company, sometimes, bigger companies like the Amazons of the world look at these smaller companies and they don't want you to be a competition, so they'll buy you up to either buy your intellectual property or to make sure you don't compete against them. And so that could happen. The rich or ruler, the trade-off of entrepreneurs, right? Entrepreneurs who give up a bigger slice of equity to investors tend to build more valuable companies. And of course, any investment comes with a price. You need to have a very clear idea how you can run your business and what matters the most. And startups may not have the expertise or financial resources to make and sell a product to customers or know how to set up an after-sale service. So again, you need to hire the right people. Maximum control over wealth and vice versa can negatively impact business. And so that is chapter 13 of the Entrepreneurship Textbook, 3rd edition.